Do you remember at the end of January, just as the S&P hit an all-time high, Bank of America caused a stir when they announced that one of their proprietary guaranteed bear market indicators was just triggered. What was remarkable about this particular indicator was that it predicted not only the size of the upcoming drop, but also the timing. Also notable, its uncanny accuracy. It was correct on 11 out of 11 previous occasions after it was triggered. Well, as of Thursday of last week, 13 of 19 bear market indicators have been triggered. So I hope 13 is your lucky number. Let's take a look. Back in early 2018, Bank of America's bull and bear indicator had surged to 7.9, and the bull bear indicator had given 11 sell signals since 2002, which was a hit ratio of 11 out of 11. And at that time, Bank of America's conclusion was that a tactical S&P 500 pullback to 2,686 in February or March was now very likely, again, back in early 2018. So in retrospect, Bank of America was absolutely spot on with a 10% correction hitting the very next week, and then another 10% correction hitting for a second time just 1 month after that. So this is important because that particular crash indicator was triggered in the context of B of A also reporting shortly prior that 11 of 19 of its broader bear market signposts had also been triggered. So we fast forward to today, when the bear market is that much closer, according to Bank of America, which reports that as of last week, another two indicators had been triggered, meaning that no less than 13 of 19 bear market signposts are now flashing red. And this was Bank of America's take on that particular very late cycle indicator. According to Bank of America, we compiled a list of bear market signposts that generally have occurred ahead of bear markets. No single indicator is perfect, and in this cycle, several will be undoubtedly lag or not occur at all. But while single indicators may not be useful for market timing, they can be viewed as conservative preconditions for a bear market. So today, 13 of 19, or about 68%, have been triggered. So in other words, we are more than 2/3 of the way to the next crash, recession, or depression. And that also means that just two more indicators have to trip before Bank of America's guaranteed recession trigger is activated. So this is a list from Bank of America showing all 19 triggers. And if we go into this column here, we can see that as of January 26, 2018, these 11 triggers had been completed by that time. And then, of course, it was shortly followed by the correction in late January, early February. And now we have 13 of the 19 triggers through this column here. You can see in the last two triggers that occurred, number one was the trailing PE plus CPI. Again, the PE plus CPI is greater than 20 within the last 12 months. And then the second trigger is that in the preceding 12 months, the market had pulled back by 5% at least once. And we know that occurred, of course, in late January, early February. So there are only 6 triggers remaining. But mind you that we only need 2 more triggers to ensure, according to Bank of America, that guaranteed bear market. While over 2/3 of B of A's bear market checklist being triggered sounds bad, this chart here shows that on a historical basis, the minimum threshold again for a bear market onset was not less than 80% of the signpost flashing red. Again, that means we're 2 more triggers away from that guaranteed bear market. However, we're at 68% now, and that still means caution. And in my opinion, it also means raise some cash, get some dry powder ready. And this chart here is another representation showing that currently we are on our way up to that guaranteed bear market. And according to Bank of America, I quote, our U.S. regime model, a quantitative framework for stock picking, suggests we are in the mid to late stages of the market cycle, and in this stage, momentum is the best way to invest. As contrarian value investors, this is not an easy call to make. But if this bull market is closer to over, our analysis of factor returns indicates that late stage bull markets have been dominated by stocks with strong price momentum and growth, while value, analysts neglect, and dividend yield have been the worst performing factors. And that's a very interesting statement. So, as a value investor myself, I've noticed that when markets do have difficulty, even if you're buying low, those stocks can get hit hard too. So, once again, be cautious, raise some cash. And for today, that's ChewDog Charts. Thank you.